Just 1 week ago, the CBOE Volatility Index trundled along at a reading of around 13, as investors eyed record highs for stocks. That lack of volatility implied a subdued outlook ahead in spite of a potentially problematic set of events, including US payrolls, a slew of central bank meetings, and the British referendum over its EU membership. Subsequently, things have turned pear-shaped for investors. The yen is surging to a 2-year high against the dollar on concerns global central bankers are becoming increasingly powerless. The threat of not only a British exit from the EU, but also a breakup of the euro area itself has the dollar powering ahead against both the British pound and the euro currency. Contagion fears have boosted the cost of stock market protection as measured by the VIX index to above 20. Global government bond yields are moving deeper into negative territory as each day passes, dragging an increasing part of the maturity spectrum into the red. The 10-year German Bund is the latest victim, dipping below the zero yield line for the first time on record. Much of the problem lays firmly with Britons, who may vote to slam the door shut on Europe. Voters have become embroiled in bitter nationalistic arguments and utter frustration with political establishment over incremental losses to national sovereignty. Suddenly, stock market investors are faced with a perfect storm of global events that scream risk off. The environment worsened following the updated projections at the FOMC, who some say did a 180-degree turn on its path to normalise rates based on 1 month's weakness in the labour market. Despite closing in on full employment, many committee members reflected the threat to the international and domestic economy by lowering their expectations for the appropriate stance of monetary policy over the next several years. Some currency watchers had expected the Bank of Japan to use 105 per dollar as a prompt to start its buy dollar, sell yen intervention, but having reached 103.74 earlier, so far no sign. The problem now is that there is still plenty of time for investors to lose their mettle across all asset classes, and should events get out of hand, setting off a bout of global contagion, the central bank would be wasting its time trying to punish investors for buying the yen, predicated on the outcome of voting in Britain on June 23rd. The perfect storm is brewing for investors who will need more than just a steady hand over the next several days. They will need to see beyond the potential for a Brexit at the forthcoming vote. That potential might just be seen as a buying opportunity by astute investors, but there's a lot of water to go under the bridge first. That's all from IB Traders Insight. For more colour from our contributors, visit us at ibkr.com/ti.